Hello everyone, I have a question for you. Should you invest in stocks? Well, that's actually a very good question, and of course, as it is with everything in financial markets, there is not one definitive answer that could answer for you to these questions. Because it entirely depends on your resources and time that you are willing to devote to financial markets. Mainly, here's the rules of the game. To really do objective stock market research and to make some serious commitments, there requires a lot of time. That's more or less full-time work. Because if you are following conventional patterns that you are hearing from the news, or simply are making virtual portfolios with free tools, you are doing effectively that has been doing for hundreds of thousands or even a million of other retail investors and analysts out there. And in that way, it's impossible to beat the markets, or namely to perform better than broader indexes for extended periods of time. And actually, I would say you have to go to fundamental basics before you do anything, because you have to realistically understand what is that you want to achieve and how you want to achieve that into financial markets. How much money do you have, how much time do you have, and all those things which I have covered in previous video. They all have to be set in place, and only then when you understand really what you could realistically achieve and what's the effort you could put there, you could say that you have certain amount of hours and resources that you could spend, and whether or not this is appropriate for you to do some individual stock picking strategies. Because as I told you before, they will require lots of time and lots of money, and as a rule of thumb, in most cases, most people, whether they are professionals or so-called amateurs, they won't beat markets, at least with the same risk as general indexes. What I mean by that is that you may have higher nominal returns, but those from nominal returns will be achieved by so much risk and stock volatility that it would make all those returns almost meaningless. For instance, if someone, that's not stock, I know, but if someone invests, that's not right for that, someone buys cryptocurrencies and boasting that they have high returns, they are lying to you. And I think in most cases they're lying to themselves, because what they are saying, they are not saying you the returns, but they are saying simply fluctuations of that asset which look like returns. Because if something fluctuates in serious magnitudes by their own nature, like Bitcoin is extremely volatile. It's not security, it's extremely volatile thing, and that thing fluctuates widely to either direction. And in some cases people are thinking that fluctuations on upside is somehow smart return, and fluctuations on downside are simply opportunity to invest once in a lifetime or similar type of nonsense. That's simply not true, but I think those people are not completely competent in financial markets and are trying to tell themselves nice story just to have some peace of mind. But that's certainly not any kind of strategy if you want to have some serious investment plans. So with that said, I continue my previous thought. The markets are very hard to beat, and if you want to beat them, you have to, so to speak, cut angles. Now, I'm not saying that you have to do some insider trading or front running or other types of securities fraud. Not that, but what I'm meaning here is that you have to look at unconventional ways or unconventional approaches which won't be available every day at all of the times when you are watching the markets. Because like it or not, if we are using common ways and widespread ways that everyone else is using, those opportunities are getting more and more thinner. Or, if I want to say that into more fancier words, markets are becoming slightly and steadily more efficient because of the faster information, our ability to get faster internet, which means better price executions, higher liquidities due to algorithmic trading and whatnot. We could buy securities faster, cheaper, easier, and we now, not now, but for like a couple of decades at least, have we think we have more information that professional mutual and hedge fund managers had in the 70s and 80s. And all that information more or less is represented in the stock price, and stock prices most of the time are showing us fairly accurate picture, and a couple of times they are completely irrational, and those are the times when you supposedly have to make your moves. But if it were so simple, then anyone would be a billionaire, but as we know, things are not that bright. But still, what I'm saying is that if you seriously want to invest in stocks, you have to find approach and way which works for you, which has a very unconventional way how to do that. For instance, you could invest in index funds for all of the time, but wait for some extremely low probability event, such as 80% correction in some sector, for instance. You could wait from 2008-2009 crisis up until 2020, where you could find extreme bargains due to complete market panic. That is one angle. Another angle is to look at companies which have like serious corporate restructurings or litigation processes, if you know those things very well and see that something is extraordinarily overpriced. Because approaches like finding companies which have stock prices that's lower than liquidation value might be possible in the 50s when Warren Buffett was in his 20s. But I would dare you to find some of these opportunities in today's markets, at least for companies which are liquid and which has realistically tradable securities. Because if you buy securities which are not bought by everyone, you could buy simply bargains which are sitting on extremely depressed prices for 15 years. Now, this is another thing, if you see something very obvious, most of the times there is reason why something is that obvious. You simply just cannot buy a company with price to earnings at 2 or 1 because it was great value investing tool in 1960s. That doesn't work like that. You have to make some unique approaches, and you have to have relatively strict principles. Excuse me for this one, something broke, I think. But yes, you have to find quite a bit of angles, and you have to test those angles quite well. And if you have them, then you might have a chance that you could seriously beat markets. You could add some good percentages to those returns that general markets have, so that has worthwhile difference. And that's why I'm actually saying that you probably shouldn't start by stock picking strategies. If you are interested in financial markets and want to grow your capital here, you have to start with something you can understand and something you could actually do, and that is probably putting money in some reasonably good investment funds and to track general indices. This is something you have to start with. When you are comfortable with that, when you see that you could make better for yourself, then you could do some digging. You could start to talk with professionals how to better make some stock picking strategies. Or a second option is that you simply have quite a lot of money and time to devote that. Then you could hire professionals that will help you to analyze markets, and then together you could make some effort. But unless you don't have either of those two options, you're simply seeing that like 2 years ago Tesla made 10-fold increase and you want to make another so-called 10-bagger, don't do that, because statistically you will lose money. Because I'm pretty sure that absolute majority of those who invested into Tesla when Tesla made those huge gains are actually now at a loss. This is one thought to consider. prices might be rising, but they are falling, and we have to make best of that.